Welcome to the Deep Dive, where we take the complexity of modern finance and technology and distill it into something genuinely useful for you. Today, we are wading deep into one of the most volatile, highest-stakes corners of crypto, the world of stablecoins. Specifically, we're tackling this fundamental contradiction. How do you guarantee rock-solid stability while also generating really competitive and, let's be honest, aggressive yield? Our sources today, a collection of quantitative research papers and some pretty intense market postmortems, they set up this crucial comparison between the failed model of Terra USD and the newer synthetic architecture of Athena's USD. So our mission is pretty simple. Unpack this new generation of stablecoins, figure out how they're generating these returns, and decide if Athena has actually solved the stability problem, or they've just swapped one catastrophic risk for another.
I think we have to start with the lesson that Terra USD taught everyone, the hard way.
Right.
Stability in crypto is not. It's not a given. Our research is emphatic on this. It's an emergent and fragile state. It has to be constantly maintained.
And what are the two absolute pillars for that stability?
Sustained market confidence, first and foremost. And that comes from transparency and just working day in and day out. The second is effective convertibility.
Meaning you can get your dollar out when you want it.
Instantly. Any holder, big or small, has to be able to cash out for that pegged value, and that requires massive guaranteed liquidity.
And when that fails, well, you get the ghost that still haunts the industry, you get Terra USD. It's actually hard to overstate the psychological damage that collapse caused.
It was a reckoning, truly. The UST mechanism, it was supposed to be this self-correcting machine, but it was built on an incredibly fragile foundation. It used an algorithmic mechanism tied directly to its sister token, Lune.
So for anyone who maybe missed that particular nightmare, how did that actually work in theory?
The simple version is that you could always swap $1 of UST for exactly $1 worth of Lune and vice versa. So the protocol relied on people burning Lune to create more UST or burning UST to create Lune, all to keep that $1 peg.
Just simple supply and demand balancing, in theory.
Right. If UST dropped to 99 cents, you had a huge incentive to buy it, burn it for $1 of Lune, and pocket the difference. It should have pushed the price back up.
Except it didn't. When the selling pressure got too intense, the market realized the collateral backing the whole system just wasn't there.
Exactly. The arbitrage mechanism it broke under stress. It created a death spiral where Lune's supply went to infinity and UST went to basically zero.
We're talking tens of billions of dollars in losses in May of 2022.
It was the single biggest wake-up call the industry has ever had. It just proved that these purely algorithmic, unbacked approaches have a fatal weakness.
So that brings us directly to Athena. The algorithmic model failed spectacularly, but the market's hunger for that stability plus yield combo didn't go away. What new model is Athena trying?
They're responding to what the sources are calling the dual mandate. The market has decided stablecoins aren't just for payments anymore. They're expected to be investment products.
And the data backs that up.
It does. Over half, 56.8% of stablecoins now offer some kind of native yield. And here's the kicker of that group. Over 83% offer yields that are higher than the U.S. 10-year Treasury benchmark.
Wow. Okay, that is aggressive. To deliver stable value and beat treasuries, the risk has to be coming from somewhere.
It absolutely does. And that risk is managed through this complex structure called a synthetic dollar protocol. Athena's USD is synthetic because it's not just backed by cash in a bank.
Okay, let's get into the mechanics, because this is where it gets a little dense. We know Athena uses an arbitrage model to be delta neutral. How do they pull off high yield without taking on massive price risk?
The core technique is something called delta-hedging. You can think of delta as just a measure of price sensitivity. If you hold 1 ETH, your delta is +1. You are fully exposed to its price swings.
Right, so to be delta neutral, your goal is to be totally insensitive to the price going up or down.
Precisely. And Athena does this by holding 2 offsetting positions at the same time. First, they have long exposure. Their collateral is in things like staked ETH and Bitcoin. That's the positive delta.
Oh.
Second, they immediately open short perpetual futures positions for the exact same value, and that's the negative delta.
So, if the price of ETH goes up, the value of their staked ETH goes up, but their short position loses the exact same amount.
They cancel out. And if the price goes down, the loss on their collateral is perfectly offset by the gain on their short position.
The directional price risk is gone. You're hedged.
And that is why it's a synthetic dollar. It tracks the dollar because it literally doesn't care what the underlying crypto asset is doing.
Fascinating. So if the price moves cancel out, where on earth does the yield come from? The money has to be generated somehow.
And this is the really clever part. It all comes from the derivatives market's funding rates.
Okay.
See, perpetual futures contracts don't expire, so exchanges need a way to keep the contract price tied to the actual spot price. That mechanism is the funding rate.
It's basically periodic payments between the traders.
Correct. And here's where it gets interesting for Ethena. In a bull market, which is pretty common in crypto, lots of people want to go long. So to balance things, the exchange makes it expensive to be long.
So they create a positive funding rate.
Yes, which means traders holding long positions have to pay traders holding short positions.
And since Ethena is always the one holding the short position to stay hedged,
They're on the receiving end of those regular, often substantial funding payments. That is the yield generation engine for USD holders.
is there a concrete example of that?
Yeah, our sources had a good one. If Ethena is running, say, a $100 million position, and the annual funding rate is a pretty standard plus 10%, they're earning about $10 million a year just from those payments. It's a way to directly profit from bullish market sentiment.
But the existential risk here seems incredibly obvious. What happens when the market turns bearish and that funding rate flips negative?
Well, now Ethena has to pay. As the short holder, they're paying the longs to keep their hedge open. And that can become a massive continuous drain on their capital.
It could eat away at the collateral itself. How do they defend against that?
They have a two-pronged defense. First, they have a dedicated reserve fund. Its whole job is to absorb those negative funding payments. Second, they use what they call dynamic allocation.
Meaning what exactly?
When funding rates are low or negative for a while, the protocol can actually shift assets away from the derivatives and into simple liquid stablecoins that are earning safe U.S. Treasury rates.
That seems prudent, but I have to push back on the historical data. Our sources say the longest streak of negative funding days was only 13 days versus 176 consecutive positive days. That feels like a massive assumption to build a multi-billion-dollar product on.
That is the $11.75 billion question, isn't it? The sources are clear that this reliance on historical averages is a point of fragility. The whole model is built on the belief that the crypto market will remain structurally net long over time.
But one really sustained, grinding bear market could be devastating.
It could. 6 months of negative funding could wipe out a huge chunk of that reserve fund and force them to de-risk everything very, very quickly.
So the size of that fund is a balancing act. Too big, and it drags down the yield. Too small, and they risk a collapse.
Exactly. And this brings us from market risk to the other huge issue, counterparty risk. To understand this, we need to look at how they handle their collateral. Ethena uses something called Clearloop from a provider named Copper. It's an off-exchange settlement system.
What does that mean for the average person, off-exchange settlement?
It means Ethena deposits its collateral, the staked ETH, the Bitcoin, with an institutional custodian like Copper or Anchorage Digital. The crypto exchange where they are trading never actually holds their assets.
So the collateral is kept in, what, bankruptcy remote custody?
Exactly. It protects their assets if an exchange like Bybit or Binance collapses.
That sounds like a huge improvement.
It is, for the collateral. But here's the catch. This is the risk transfer. Clearloop doesn't eliminate risk, it just moves it. It transfers the counterparty risk squarely onto the exchange.
So.
Because Ethena is holding these enormous short positions, the exchange is the direct counterparty to every single one of those trades. So if Ethena has a problem or tries to unwind billions of dollars of shorts at once...
The exchange is left holding the bag.
Exactly. And we saw a preview of this during the Bybit incident in early 2025. It was manageable then because other exchanges stepped in to share the loss, but the expert analysis we read was pretty clear.
It was a warning shot, not a real stress test.
Correct. The analysis concluded that if Ethena's positions were concentrated on a purely derivatives-focused exchange, or if the product was just twice as large, a similar event could have been catastrophic for that exchange.
And this is where the research draws a really scary parallel.
It does. The argument is that this entire synthetic stablecoin architecture, using short-term debt instruments against volatile collateral, is basically recreating the pre-2008 systemic risk model from traditional finance.
But with one massive difference.
The bailout facilities. DeFi has no Federal Reserve, no IMF. There's no multi-trillion-dollar liquidity backstop when things go catastrophically wrong. As one analyst put it, the risk cannot be hypothecated into non-existence.
Can you translate that? What does that practically mean?
It means you can shuffle the risk around. You can move it from your balance sheet to the exchange's balance sheet or into a reserve fund, but you can't make it disappear. It always lives somewhere in the system.
And it can show up fast. USD has had depegging events, right?
Yes, there was a notable one during a market rout on October 10th, 2025. And it showed that their strategy of, take risk in a bull market, shift to cash in a bear market can be way too slow when DeFi liquidity vanishes in an hour.
So how do they adapt? What does USD look like today after that scare?
They've walked back from the original vision quite a bit. To lower the risk, USD is now backed up to 2/3 by other stablecoins, not just the short derivative position.
Which lowers the risk, but it must also compress the yield they can offer.
Dramatically. It makes it less unique and honestly much closer to a more traditional stablecoin.
This whole shift really brings us to a broader analytical point from our sources. This idea that the choice of a stablecoin is really a choice in risk specialization.
Yeah, there's a great quantitative methodology for this called the stablecoin Lego framework.
Lego framework.
Yeah, it looks at risk not just from upstream factors and threats to the protocol itself, but also by downstream composition. It asks a critical question: who actually holds the coins? Because the answer tells you what the blast radius will be if it fails.
So the risk profile is totally different if it's mostly held by whales versus a bunch of other DeFi protocols.
Exactly. And the framework identifies three really distinct risk archetypes. The first is DeFi-centric, like USDD. Almost all of it, 98.1%, is held and used inside other DeFi protocols.
Which creates what kind of risk?
Massive contagion risk. A single vulnerability in one major protocol that holds USDD gets amplified and spread across the entire ecosystem instantly.
Okay, so the blast radius is huge. What's the second archetype?
Exchange-centric, like FDUSD. About 97% of it is concentrated on centralized exchanges. Here, the risk shifts completely away from the code and onto the solvency of a corporation. The coin is basically an IOU from Binance.
And the third, the concentration risk.
That's the whale-dominated archetype, like TUSD. Over 94% is held in a small number of private whale wallets. This creates a huge vulnerability to a bank run. It would only take a few large coordinated players to decide to exit at once.
You know, what stands out to me from that framework, though, is the system-wide vulnerability. It says that for almost all major stablecoins, the biggest quantifiable risk is something called the peripheral factor.
That's right, and that accounts for 40 to 50% of the total risk score.
And that's not the core financial mechanism?
No, it's the operational stuff. It's failures in external price oracles, it's access control issues, rug pulls, governance attacks. It's the loose nuts and bolts, the connective tissue holding all the Lego bricks together. That's what's most likely to break.
So we circle all the way back to where we started. This relentless hunt for competitive yield forces designers into these incredibly complex trade-offs. They stop being simple anchors and become these hyper-complex financial instruments.
And that institutionalization continues. As of early 2026, Ethena, now managing an $11.75 billion collateral pool, onboarded Kraken Custody, which is a U.S. state-chartered bank, to join their other custodians. It's a clear move to diversify the provider risk across different legal jurisdictions.
It's a prudent move, but here is the final, I think, provocative thought for you to consider. The greater risk with every successful stress test of a synthetic stablecoin isn't the failure itself. It's the fact that traders start to treat them as the functional equivalent of a simple reserve-backed stablecoin. They get complacent. So you have to ask yourself, what is the real cost of that yield? And is the risk of a systemic failure truly manageable if, as one source notes, the stability of the entire system depends on multiple different things? A funding crisis, an exchange hack, a governance failure, not all happening at the same time. That's the kind of complex calculus you can take with you from this deep dive. Thanks for joining us. We'll be back next time with another stack of sources to unpack.